If any of you have ever owned your own business, then you know that reporting positive net income and generating net income is a wonderful thing, and that's very important to any lenders and any potential investors for your company. However, net income isn't the same as cash, and ultimately companies need to have a positive, reliable stream of cash flows. The income statement, as you know, reports net income by measuring revenues and expenses using the accrual method of accounting. So the income statement gives us a nice reflection of the results of operations of a company, but it really doesn't give us a lot of information about cash flows in a very direct manner. For that reason, and because cash flow is such an important indicator of a company's financial health, companies include in their financial statements a statement of cash flows, and that of course is what we will be looking at in this video. We don't spend very much time in the course on the statement of cash flows because as far as theoretical implications go, there's not much to it. There's some interesting procedural aspects, but they're really beyond our scope. Here we'll just be talking about the basics of a statement of cash flows. Here in front of you, you see the basic structure of a statement of cash flows. The purpose of this statement is to explain for readers why cash changed during the accounting period. So the first thing that you see on the statement of cash flows is near the bottom, you see the beginning balance in cash that comes straight from the balance sheet, last year's ending balance, and the current ending cash balance. The difference between cash at the beginning of the year and cash at the end of the year is the change in cash during the accounting period. And what the statement of cash flows wants to do is give the readers a little bit more information about that change in cash. In particular, we split that change of cash up into 3 different types of activities. We explain how much of that change in cash came from operating activities, investing activities, and financing activities. Before we define what those activities are, let me explain what cash equivalents are. And that's because on a statement of cash flows, that cash number, beginning and end of the year cash number, includes both cash and cash equivalents. Cash, of course, is just all of the company's checking accounts, savings accounts, currency on hand, all that kind of stuff. But a company includes both that and cash equivalents in the category of cash presented on the statement of cash flows. Cash equivalents are short-term, highly liquid investments with a very small amount of risk. By short-term here, we mean with a maturity of less than 90 days. Now let's talk more about each of those different types of activities. Let's start with financing activities, and I like to do it this way because I think of a brand new business starting out. And what's the first thing that new business is going to need? It's going to need some financing. Well, of course, there's 2 basic types of ways in which a business can be financed. It can be financed through owner's equity, cash that the owners put into the business, or the business can go out and borrow from third parties, and most often businesses have both of those types of financing activities. Here's a list of how we define financing activities, and keep in mind that these are definitions specific to the statement of cash flows. The statement of cash flows gives readers information about the financing cash inflows and the financing cash outflows. Inflows from financing come from issuing stock to investors or from borrowing. And here we're talking about when businesses just go to a lender and get proceeds from a loan, or when the company issues bonds and borrows in that manner. Outflows, financing outflows, would include when a company pays back that borrowing or retires those bonds, and it includes a couple of more things as well. It includes when a company buys back some of its own stock. That's called a treasury stock purchase, and that's something we'll talk about much later in the course. And the other thing here as a financing outflow is when the corporation pays dividends to the shareholders. So dividends are considered, the payment of dividends is considered to be a financing cash outflow. Well, once a company has financing, the next thing that it generally does is go out and invest some of those funds that came from financing into assets that the company needs to operate. So this category is cash flows from investing activities. And once again, remember that these definitions are specific to how we use the term for purposes of the statement of cash flows. Investing activities generally are related to purchases and sales of long-term assets to the extent they used cash. So the most common inflows that qualify as investing activities are when a company sells property, plant, and equipment type assets for cash. Similarly, if a company sells investments in stocks or bonds, those will generally qualify as investing activities. And finally, if a company makes a loan to someone else and that someone else pays the company back some principal on that loan, that will also qualify as an investing activity. So here you see sales of various types of generally long-term assets, all qualifying as investing cash inflows. Outflows, cash is just going the other direction. When a company purchases property, plant, and equipment type assets for cash, purchases long-term investments, or loans some other party money, those would all be cash outflows that would be reported as investing activities. And our last category here is operating activities, and this would be the most common type of activity for most companies. So basically anything that isn't defined as a financing activity or an investing activity would be an operating activity. So as you'll see here, these are things that are related to the company's normal operations. Cash inflows from operating activities would be things like when they get cash from a customer for providing goods and services. And of course, the collection of cash from that customer, the timing of that, may be totally different than when the company recognized revenue related to that sale. You also see included here, we have interest collected on receivables and dividends received. Now, a lot of times it feels like these things should be investing cash flows because they seem like they're sort of investment related, but they're not. If a company collects principal on a loan that they made to somebody else, that's an investing cash flow. But when they collect interest, that's considered to be an operating cash flow. If a company invests in the stock of another company and then they receive dividends on that stock, that's also considered to be an operating activity. Outflows that qualify as operating activities would be things like when you pay your vendor for goods that you're eventually going to sell to your customers. So when you're making payments to purchase your inventory, that would be an operating cash outflow. If you pay income taxes or when you pay income taxes in cash, operating outflow. Salary and wages, rent, property taxes, the list here could be very, very long. And once again, notice that if you pay interest on a debt, that's being classified for this purpose, again, purpose of the statement of cash flows, as an operating cash outflow. So let's go back and look at the structure of the statement again. Again, let's say that a company's change in cash for a given year was an increase in cash of $100,000. This section of the statement of cash flows would show inflows and outflows from operating activities, inflows and outflows from investing activities, and inflows and outflows from financing activities. The net of each of those things would be reported here, and when you add them all up, they would have to add up to a positive $100,000 change in cash for the period. But you or any other reader would be able to look at these totals and the detail within and have a pretty good sense of what caused the changes in cash. Analysts often, in fact, like to look at cash flows from operating activities, and they use that instead of net income when they do particular types of ratio analysis. Well, there's another format concept that I'd like to talk about a little bit here, and this applies just to the cash flows from operating activities section of the statement of cash flows. That particular section of a statement of cash flows can be shown to users in two different ways. A company can use the indirect method or the direct method of reporting cash flows from operating activities. You have an handout example that you can look at that contrasts these two methods for a company, and you can see that they end up, of course, reporting the same cash flow from operating activities, but the information presented looks quite different. The direct method is probably the way most of us would think that companies would prepare the operating section of the statement of cash flows. Basically, under the direct method, you could see listed all of those various cash inflows and cash inflows that we said qualified as operating cash flows. For example, there would be a line item, collections of cash from customers, cash paid for rent, cash paid for wages, all of those kinds of things. The direct method is actually the method that the Financial Accounting Standards Board prefers that companies use, but it's actually rarely used in reality. And in fact, as you see over here, the indirect method is used by about 97% of companies that file public accounting reports here in the U.S. The indirect method shows operating cash flows by starting with net income, doing a variety of adjustments, and adjusting from net income on the income statement to operating cash flows. Now, why is the indirect method the one that's used by such a majority of companies? Well, when FASB made the rules, they actually stated that they preferred that companies use the direct method for their financial statement reporting purposes. But they also required that any company that used the direct method for the operating activity section of the statement of cash flows, they required that those companies also needed to show the indirect method of computing operating cash flows as a footnote disclosure. And since companies were going to have to do the indirect method anyway, most companies totally skipped using the direct method and simply used the indirect method for reporting operating cash flows. So the indirect method is what you'll generally see in corporate financial statements. Realize that the only difference between these two approaches is in how the operating activity section of the statement is formatted. The dollar amounts of operating cash flows would be identical between the two methods, and the rest of the statement of cash flows would also be identical.